In this video, I want to show you how to read volume correctly. Not just what volume is, but what it actually means, why it matters, why a big candle can sometimes be dangerous, why a small candle can sometimes be powerful, and how volume can help you see the hidden story behind every move on the chart. Because once you understand volume, candles stop looking random. Every candle begins to tell you a story, and volume becomes the proof behind that story. This is not financial advice. This is simply education. So let's get into it. Every chart speaks two languages at the same time. The first language is price. Price tells you what happened. Did the market go up? Did it go down? Did it move sideways? That is the surface level information. It is the headline, the result, the thing everyone sees immediately. The second language is volume. Volume tells you how much participation stood behind that move. It tells you how much activity happened there, how much money moved, and how much conviction was involved. If price is the result, volume is the number of people who showed up to vote. Imagine an election. If one person wins, the result matters. But if only 10 people voted, the result does not carry much weight. If 10 million people voted, that result means something much more serious. The same idea applies to the market. A big green candle on low volume should make you suspicious. A big green candle on high volume shows much stronger commitment. So from now on, whenever you look at a chart, do not only ask, where did price go? Ask a better question. How much real participation was behind that move? That one question can change the way you read the market. Now, here's the most important idea in this entire lesson. If you want to understand volume, you only need one mental model at the beginning. Just one. Effort versus result. In the market, effort is volume. It shows how much energy, activity, or money is being used. Result is the candle. It shows how far price actually moved. When you compare the effort with the result, you start to understand whether the move is healthy, weak, suspicious, or potentially reversing. Think of it like pushing a car up a hill. The pressure on the gas pedal is the effort. How far the car moves is the result. If you press the gas and the car moves forward strongly, effort and result match. Everything makes sense. On a chart, this looks like high volume with a large candle. There is strong participation, and price is moving with it. That is usually a healthy move. But imagine pressing the gas hard, the engine roaring, fuel burning, and the car barely moving. Now something is wrong. There is a lot of effort, but very little result. On the chart, this looks like massive volume underneath a small candle. This is one of the most important warning signs in trading because it often means absorption. Absorption happens when one side is pushing hard, but the other side is strong enough to absorb that pressure. For example, buyers may be entering aggressively, but a large seller is sitting there quietly, absorbing those buy orders. The candle does not move much because every attempt to push price higher is being met by supply. It is like water pressing against a dam. The water keeps coming, but the dam holds. And when the water finally runs out, there may be no energy left to keep pushing. That is why high volume with little price movement can become a serious warning sign. Now imagine the opposite situation. You barely press the gas, but the car rolls forward easily. There is not much effort, but price still moves. On the chart, this can look like price moving upward on low volume. This does not always mean buyers are extremely strong. Sometimes it means sellers are simply absent. There is no resistance. Nobody is standing in the way. This is where the idea of no supply or no demand comes in. If price can rise with little volume, it may mean there is no meaningful selling pressure. If price can fall with little volume, it may mean there is no meaningful buying pressure. The move is not powerful because one side is aggressive. It moves because the other side is not there. Click below description if you want more simple trading lessons that help you understand what is really happening behind the candles. So here is the basic volume matrix you need to remember. High volume plus a large candle usually means a healthy move because effort and result match. High volume plus a small candle can mean absorption because there is a lot of effort but little result. Low volume with price still moving can mean no supply or no demand because the opposite side is absent. These three combinations are the foundation. If you remember them, you will already read volume better than most traders who only look at green and red candles. Now let's take this idea and apply it to real candle patterns. This is where volume spread analysis, or VSA, becomes useful. VSA is not about memorizing random candle names. It is about understanding the relationship between volume, candle size, and where the candle closes. The first pattern you need to understand is stopping volume. Imagine price is falling hard. Red candle after red candle appears on the chart. Everyone is panicking. Traders are selling. Fear is spreading. Then suddenly, you see a large red candle with huge volume underneath it, maybe the biggest volume in weeks. At first, most traders see that and think the selling is extremely strong. But look closer. The candle does not close at the very bottom. It leaves a long, lower wick, and the close is somewhere near the middle or upper part of the candle. That tells a very different story. It means sellers pushed hard, but someone bought into that selling pressure. Someone with serious money absorbed what panicking traders were throwing away. The market tried to go lower, but despite huge selling activity, price could not close at the low. That is effort versus result. High effort, limited downside result. This can become stopping volume, and it may signal that selling pressure is being absorbed near the bottom. It does not mean you buy blindly, but it does mean you should pay attention. Something important may be happening there. The second pattern is buying climax. Now imagine the opposite. Price has been rising for days or weeks. Everything looks bullish. News is good. Social media is excited. Retail traders are jumping in because they do not want to miss the move. Then you see a huge green candle with extreme volume, maybe the highest volume on the entire chart. To beginners, this looks like massive strength. It looks like confirmation that the move is real. But sometimes this is not pure buying strength. Sometimes it is selling disguised as buying. Why? Because large players need liquidity to exit. They cannot sell a massive position into an empty market without pushing price down against themselves. So they wait for excitement. They wait for retail traders to chase. They wait for demand to become emotional. Then they sell into that demand. The candle looks strong because buyers are rushing in. But behind the scenes, smart money may be using that wave of buy orders to unload. It is like a vendor at a night market. The busiest moment is often when they clear the last of their stock. The crowd thinks everything is exciting. The seller knows it is time to leave. That is why the moment you feel the strongest urge to FOMO into a move can sometimes be the exact moment larger players are exiting. The third pattern is the no supply test. Imagine the market is in an uptrend. Price has moved higher, then pulls back a little. At first you feel nervous. You wonder if the trend is ending, or if the correction is about to become something larger. Then you check the volume. The pullback candle is small and red, but the volume is very low. That tells you something important. The market is asking, are sellers interested here? And the low volume answers, not really. Sellers are not showing up with strength. The pullback may simply be a test, and if no real selling pressure appears, the uptrend may continue. This is why no supply is powerful. It does not mean buyers are aggressively attacking at that exact moment. It means sellers are absent. And when sellers are absent inside an uptrend, price does not need much effort to continue higher. So now you have three important patterns: stopping volume, buying climax, and no supply test. Different situations, but the same mental model: effort versus result. Once you understand that model, you can read a large part of what volume is telling you on almost any chart. But before we go further, we need to clear up one of the biggest mistakes traders make with volume. Many traders believe that green volume means buying and red volume means selling. That is not how volume works. Every trade always has both a buyer and a seller. If you buy 100 shares, someone else sold you those 100 shares. If you sell, someone else bought from you. Volume does not tell you that only buyers or only sellers were active. It counts the number of transactions. The color of the volume bar usually follows the candle. If the candle closes higher than it opened, the volume bar may appear green. If the candle closes lower than it opened, the volume bar may appear red. That does not mean green volume is pure buying or red volume is pure selling. Think of a fish market early in the morning. The place is packed. There are buyers everywhere and sellers everywhere. The market is busy. That is high volume. But you would not say the entire market is only buying or only selling. You would say there is activity. To understand who is winning, you must look at where the candle closes, how large the candle is, where the wicks are, and how much volume supported that candle. Do not focus on the color of the volume bar. Focus on the size of the volume bar and the close of the candle. Size plus close position tells the real story. Now let's talk about one of the most powerful warning signals in volume analysis: volume divergence. When price and volume agree, the trend is usually healthier. If price is rising and volume is also rising, the move has participation. If price is falling and volume rises with the fall, sellers are active. But when price and volume begin to disagree, that is when you should pay attention. Imagine price keeps making new highs. The chart looks strong. Everyone is bullish. Each breakout looks exciting. But when you look at volume, something is wrong. The volume bars are getting smaller. Each new high is being made with less participation than the previous one. That is a warning. Think of a rocket launching into the sky. At the beginning, there is a lot of fuel. The rocket moves with power. But as fuel burns away, the thrust weakens. The rocket may still rise for a while, but the energy behind the move is fading. Eventually, it cannot keep going. That is what declining volume during an uptrend can mean. Price is still rising, but fewer traders are participating. The move may be running out of fuel. The same idea works in reverse. If price is falling, but volume continues to decrease, sellers may be getting exhausted. Each new push lower has less participation. The selling pressure is drying up. That can sometimes appear before a bottom begins to form. Volume divergence is like an early warning system. The market has not fully reversed yet, but the energy behind the current move is weakening. It is like applause getting quieter after every speech. The show is still going, but the audience is losing interest. When you see price making higher highs while volume makes lower highs, pay attention. Something may be changing beneath the surface. Click below description if you want to learn how to read market strength, weakness, and exhaustion more clearly using volume. Now let's turn everything into a simple process you can use on almost any chart. I call it the 3-step volume check. Step 1 is to zoom out. Before you focus on individual candles, step back and look at the bigger picture. Check the daily or weekly chart if needed. Ask yourself whether volume is generally increasing or decreasing. Are there any unusual volume spikes? Is the market moving with growing participation, or is the activity fading? This is like checking the weather before going outside. You want to understand the climate before you worry about one small cloud. Step 2 is to zoom in to key levels. Find important support and resistance areas on your chart. These are the places where volume becomes especially meaningful. A volume spike in the middle of nowhere may be interesting, but a volume spike at resistance or support can tell a much stronger story. If price reaches resistance and volume spikes, but the candle stays small or closes with a long upper wick, that may be absorption. The market used a lot of effort, but price could not break through. The wall may still be strong. If price breaks resistance with a large candle and high volume, that is different. Effort matches result. The breakout has more conviction. But if price breaks resistance on low volume, you should be careful. A breakout without participation can easily become a trap. Step 3 is to wait for confirmation. This is where many traders make mistakes. They see one signal and immediately enter. But one candle is not always enough. After a breakout, watch the next candles. Does price pull back to the broken level? If it does, what happens to volume during the pullback? If the pullback happens on low volume, that can be a no supply test. The market is testing the broken level and finding very little selling pressure. That can become useful confirmation. One extra candle of patience can save you from many bad trades. You do not need to catch every move at the exact first second. You need to understand whether the market is confirming the story. Let me give you a simple example. Price approaches resistance. You zoom out and notice volume has been steady. Then price touches resistance. Volume spikes, but the candle is small with a long upper wick. That is, high effort with weak result. Buyers tried to push through, but the market rejected the move. That is possible absorption. Instead of buying the breakout blindly, you wait. Price drops, and you avoided a trap. That is the power of volume. It slows you down. It helps you ask better questions. It keeps you from reacting to the candle alone. So remember the 3 steps. Zoom out. Zoom in to key levels. Wait for confirmation. That is your basic volume playbook. Before your next trade, run through a quick checklist. Is volume increasing or decreasing compared to recent candles? Does the effort match the result? If there is big volume, did price actually move strongly, or was it absorbed? Are there unusual volume spikes near key levels? Is volume diverging from price? What does the next candle confirm? When you ask these questions, you stop guessing. You start reading the market with more depth. You are no longer looking only at whether a candle is green or red. You are looking at participation, pressure, resistance, exhaustion, and confirmation. Because volume is not just another indicator on your chart. Volume is the truth serum of the market. Price can be pushed around. Price can create traps. Price can make beginners feel emotional. But volume shows you where real activity is happening. It shows you where money is stepping in. It shows you when effort is strong. It shows you when effort is failing. It shows you when a move has conviction and when a move is running out of fuel. And once you start reading volume this way, every candle becomes more meaningful. A breakout is no longer just a breakout. A pullback is no longer just a pullback. A big candle is no longer automatically strong. A small candle is no longer automatically weak. You begin to understand the story behind the candle. And that is where trading becomes clearer. Click below description if you want more simple trading education that helps you understand the market beyond basic patterns and indicators. So the next time you open your chart, do not just ask where price is going. Ask what volume is saying. Ask whether the move has real support behind it. Ask whether effort matches result. Ask whether buyers or sellers are becoming exhausted. Ask whether the market is showing conviction or hiding weakness. If this video helped you see what is happening behind the candles, let me know in the comments. Which volume pattern will you look for first? Stopping volume? Buying climax? No supply? Or volume divergence? Drop a comment. I read every single one. Stay patient, stay disciplined, and I will see you in the next video.